In this video, I'm going to share 10 timeless investment principles from Warren Buffett. Number 1. Warren Buffett quotes, "Look at the stock market fluctuation as your friend rather than your enemy. Profit from the folly rather than practice in it." But short-term prospect means the stock price can fall dramatically, all the while ignoring the long-term potential of the enterprise. These represent the buying opportunities in companies that have a good long-term economy prospects that are experiencing a short-term problems. So stay away from the company when full rushing and drive up the price, and buy when the full rush up and drive down the price. Principle number 2. Uncertainty actually is the friend of the buyer of a long-term values. Uncertainty in the stock market creates fears, and fears create panic selling, which force the price to drive down regardless of the business long-term economic prospect. So be fearful when someone is greedy, and be greedy when someone is fearful. Principle number 3. No matter how great the talent or effort, some things take time. You can't produce a baby in 1 month by getting 9 women pregnant. So it takes time for the business value to build up. It doesn't happen overnight. But if you buy a great business, eventually the values will add up to the handsome sum. Principle number 4. If past history was all there was to the game, the richest people could be a librarians. The past stock price does not tell you how the stock price is going to move in the future. Principle number 5. Look at the stock market fluctuation as your friend rather than your enemy. Profit from the folly rather than practicing in it. Understanding business history is important, is to understand what can happen, but it won't tell you what will happen and when will it happen. It takes some foresight of the part of the investor. Warren has tried to predict the future by staying with the business that make products that don't change over time. Predictable products equals to the predictable profits. Only buy something that you are perfectly happy to hold if the market shut down for 10 years. So when you start thinking long terms, you start thinking quality and the long-term economy natures of the business. This leads you to ask whether the company product has a doable competitive advantage. This means high margins on a product does not have to change. This means that the plants and the equipment never go obsolete, which means you never have to retool and have a low research and development cost. Low cost means high margins, and high margins mean more money. The investor of today does not profit from yesterday's growth. It's the growth of the company of tomorrow that the investor of today will profit from. If I brought a business today, the profit I could be taking out of it is in the future. I don't make any money of the past. We do not have, never have had, and never will have an opinion about where the stock market, interest rates, or business activity will be a year from now. Everyone is concerned about the stock market situation, interest rate going to the next year. It means they will end up doing silly things like selling a business. There's a great underlying long-term economies because the Fed may rise interest rate a quarter point. And when these impressible investors sell great business for some silly reason, Warren is there to buy them. And once he has his hand on it, he isn't letting go. So if you want to become super rich, just ignore all the rats and the rave about the stock market is going or not going and forget about the Fed and interest rate. Just focus on determining the long-term economic value of the companies that have a doable competitive advantage and determine where they are selling in relation to that values. When they are undervalued, buy them. When they are overvalued, stay away from it. And if you are diligent and stay with the program long enough, you will eventually acquire a portfolio of fantastic company that will make you super rich over the long run. For some reason, people take their clues from price action rather than from the values. Price is what you pay, but value is what you get. So Warren believes the pace you pay determines the amount of the value you get. Pay too much and you get little values. The less you pay, the more values you get. Investment must be rational. If you don't understand it, then don't do it. Warren makes it a point to understand each and every business in which he invests. He likes a sure thing. A business he understood and he is selling at the actual period. He leaves the price diagram to other people's. If you like my video, please subscribe to my YouTube channel by clicking the subscribe button below. Thank you very much.